Hey everybody, welcome back. You're tuning in to howtoplaystock.com. My name's Kepley. In today's video, I wanted to cover the subject of 401ks and kind of compare that to a do-it-yourself type investing approach. And we're going to kind of shed some light on different things and determine, what might be a better route to go instead of just going with a 401k. There are some disadvantages to both, and I'm going to go ahead and try to cover some of that with you. But today's video, just, in general, I wanted to cover the 401k because there's so many people that are tied up in 401ks and they're dependent on them for, retiring, and just basically praying and hoping that they're wealthy, when they end up getting out of the 9-to-5 rat race. So stick around, keep watching, and I'll see you guys in the next portion of this video. Okay, so getting started here with this video on 401ks, I want to ask you guys a question first. How many of you right now are invested in a 401k through your employer? I know I am, and I'm not, against 401ks or investing in them. So don't think that I'm bashing the 401k here so much. I'm doing more of a comparison between the 401k account and do-it-yourself type approach when it comes to your retirement and just building wealth in general, okay? So don't think I'm knocking the 401k account, because I'm not. That's not the purpose of this video, is to just attack the 401k account. I think they are good. And one of the advantages that I like about 401ks, if you have one with an employer, the employer, not all the time, but most of the time, they'll end up matching you a certain percentage on the pre-tax money that goes into your 401k. So you can get some free money out of the deal through your employer to help, grow your wealth at a faster pace. So I do like that about 401ks, but let's go over some disadvantages, because that's more what I try to focus on, is the disadvantages to different strategies when it comes to investing. Because if you know your disadvantages and you know what's holding you back and keeping you from being able to stay liquid in times of like a financial crisis like what we had in 2008, if you know how to stay liquid, you're much better off surviving any type of financial crisis that might come. You're also much better off being able to reduce your risk and balance a portfolio so that you're not losing as much when you go into like a financial crisis or a stock market correction or something, that effect. So getting started with the 401k, the 401k was basically created in 1974 through the ERISA Act, and that is the Employee Retirement Income Security Act. Okay, now that was created in 1974. I shot a video on this not too long ago, and I explained, what the ERISA Act was. So you can go back and check that out if you want. Just subscribe to the channel. But the ERISA Act is what created the 401k account. Okay. Now, what I do not like about 401ks is that when you're investing in a 401k, they have rules and regulations around that account. One of those being that if you want to get access to your funds, okay, and you want to withdraw that money and, do whatever you want with it, whether it be for financial hardship or just to protect your wealth in general so you're not losing all your wealth, you're going to take a hit on that. Okay, they're going to tax you out the ass, pardon my French here, but they're going to tax the crap out of you. You're going to get a 10% tax as soon as you withdraw, and then you're going to get taxed on the front end of it, because it's considered ordinary income. So you're going to get taxed at the max rate of around 35%. So if you add that all up, you're looking at a total tax on your 401k account of around 45%. Now, I don't know about you, but when I go to make an investment in anything, if somebody ever tells me that, for instance, an example here. Let's just say I come to you and I go, hey, I got a great investment for you. And here's the deal. You give me $5,000, okay? I'll put it in an account for you. I'll manage it so you don't have to manage it yourself. You don't have to worry about that. And then on top of that, if I can get you a return, because there's no guarantee, if I can get you a return, it's gonna compound for you over time. And but if you give me that money, you're not gonna be able to get access to it. Okay, so if you want to say get that money back because I'm doing a shitty job for you and I'm not giving you good returns, if you want that money back, I'm gonna tax you too at 45%. Now, does that sound like a great investment? That is a horrible investment. And for some reason, people are being indoctrinated to believe through the corporations that when you invest in a 401k, that's somehow a good investment. For me, I don't like my odds just right out of the gate. If somebody came to me and told me exactly what I just told you, I would tell them to get lost. I'd be like, you're out of your damn mind. I don't want to invest in something like that. Who's someone to say that I'm gonna be your mommy and daddy, basically, and I'm gonna babysit your funds for you, and then you can just sit back and pray and hope that I get a return for you. And if you try to get access to your money, I'm not going to allow you access to it. Okay? Who in their right mind, feels like they have the authority to say that to you? And that's what I don't like about the 401ks. Now, the do-it-yourself approach, I think it's a must in today's society and financial markets. I think it's an absolute must. And the reason why is because the 401k, if we go back to 2008, during the financial crash with the banks, there was a large percentage of people, I don't know the exact numbers, I'd have to go back and look at it, but there was a large percentage of people who lost like half their wealth, okay? And they could not get out of their investment because they were tied into it due to the tax problems that exist with 401ks. Not to mention, if you wanted to try to, let's say you have a job, okay? Here's another thing I don't like about 401ks. Let's say you have a job right now, you're employed by somebody, and you want access to your funds. The only way you would ever be able to even get, some cash back is if you take out a loan against yourself and you pay yourself back plus interest, which if I'm going to pay any type of interest on a loan, I would much rather pay that interest to myself. So in regards to that perspective, I don't think it's such a bad deal. So you can do that with 401ks, which is a good advantage. But outside of that, you're stuck, man. Even the only way you can get access to your funds is if you get fired. And then, again, you're taxed at that 45% if you want to get access to the funds that you've been building up over time. So, again, the 401k, they called it, back in 2008, they called the 401k a 201k. And there was a reason for that. Now, the 401k is usually set up, and you've got like aggressive. Okay, so this would be for like younger people, and I'm touching on asset allocation real quick here. So this would be like allocating your funds into certain categories by percentage of the amount of money that you have in there. So you may have like 20% in bonds, 30% in equities, that kind of thing. But they're usually set up by aggressive, moderate, and then you have like conservative, okay? And each one of these is built on risk. Now, the thing I don't like about 401ks is your choices are limited. So if you ever go to your employer's 401k and you actually want to start allocating this thing yourself, you might be able to do that, but you're only going to have access to a certain amount of funds that the company offers to you. Okay, so in other words, you're not going to have access to all the financial paper assets that you'd be able to get into through a personal brokerage account. I don't like that either, because again, if I'm going to, let's just say, for instance, with the example I used, if I were to come to you and I say, oh yeah, give me $5,000, I'll manage your money for you. Oh, by the way, there's a list of maybe 10 stocks that I'm going to give you here, and that's all you have to choose from. Okay? Would you like that? Would you like that as far as your options? You're very limited with your options. So again, that's another thing that I don't like about 401ks. The aggressive, normally this is higher risk. So if you're in an aggressive account right now and you're really high risk, yes, your returns can be greater, but as soon as these markets turn over and start correcting, or we go into another stock market crash, you're going to lose a ton of money really fast. Okay, now it's only a matter of time to kind of see how that would play out and how quick you would rebound and get back into a return. Then you have moderate, which is less risky, and then conservative, which should be like really, really low risk, but it's not going to grow as much. You're not going to build as much wealth. Now with the personal brokerage account and the do-it-yourself approach, the reason why I like that one is because, again, when I'm talking about staying liquid, I'm talking about you need cash on hand. You need access to your money, okay? Especially in today's markets with how volatile they are. So a personal brokerage account allows you to do that. The other cool thing about those is if you say, let's say you cashed out on your stocks, right? Instead of paying a 10% fee up front just for cashing out your stocks, the only fee you're going to pay would be a fee for selling a certain amount of stocks. And usually that's only going to add up to maybe 10, 20 bucks. It just depends on how many sale orders that you have going. But I can tell you right now, it's not going to be a whole lot. You know, so in other words, like if you had $5,000, okay, and you withdrew that from your 401k, you're taxed at 10% right off the bat. Okay, now that's quite a bit of money. If you take that same $5,000, you withdraw it from a personal brokerage account, all right, and let's say you had like maybe 3 or 4 sell orders, depending on what the fees are, the commission fees for selling, you're probably going to be looking at maybe 20, 30 bucks, okay, that you're going to get hit up front on versus 10% on 5,000. All right, so I like that portion of the brokerage account, the personal account better, because then you have access to your funds. You may still get taxed if you were in a return on capital gains. So if you were in a positive for the year, you'll get taxed on the capital gains from that, and that'll be considered ordinary income. So you might possibly pay some taxes at the end of the year on the ordinary income portion of that. Okay, but other than that, you're not looking at a 45% tax rate on a personal brokerage account when you go to pull your money out. So you're going to have more of your money left, which for me, that's a better investment. Okay, and I don't know about you, but I'd much prefer that over, you know, having somebody telling me, hey, okay, you can only invest in these stocks. When you go to try to become liquid and get cash on hand, we're going to tax you at 45%. So you're going to lose 45% of your investment right off the get-go. I much rather would go the personal brokerage account direction than going with the 401k. Now I understand 401ks, everybody is tied into them. And that's the scary thing right now with a lot of people is they don't have the time to do research on investing and setting up a retirement account and the do-it-yourself approach. They don't have time for that because they're too busy working for someone else. And it's just, they're set up for, I hate to say this, but there's a lot of people, and this is just my opinion, based off my own research, a lot of people are set up for massive failure. Massive failure. And the reason why is because of all the things that I'm talking about right now in regards to the 401k. At least with a personal brokerage account, you can get out. Like if we go into a stock market crash, you're not trapped. You're not tied into it. You can just pull your money out, take a hit on your sell order fees, and then you can sit on the bench and you don't have to participate in the next correction or the next stock market crash. All these other people with 401k accounts, on the other hand, they're trapped. They don't have a choice. They have to participate in it. Okay, and this is how a lot of the professional day traders on the stock market, talking about Wall Street, this is how a lot of these guys will make the transfer of wealth during a down market, a bear market, a stock market correction, or a stock market crash. Okay, this is how they do it. And they know everybody's tied into their 401ks, so they can't do anything about it. They're trapped. So those are just some things that, I've seen with my own personal experience with 401ks and my own personal experience with having a personal broker account set up, okay? So if you're somebody who just has a 401k right now, you might want to consider setting up something outside of that and get going on building your wealth outside of that too, because you have much more control. And I want to end with this. Risk, when people talk about risk, all risk is simply control or a lack of control. Okay? So risk equals control. So the less control that you have, the higher your risk is for losing money. The more control you have, the less risk you have of losing money, if that makes sense. Okay, so just remember that. And if you have any, doubts about doubting yourself when it comes to investing, subscribe to the channel. I've got plenty of videos that go in and break down the basics of investing, things you can do, get together a plan, help you allocate your portfolio so that you're set up to reduce your risk, so that you're not tied up in, say, like 40 or 50% equities. I go in and I explain that kind of stuff for people, and that's mainly what my YouTube channel is about, is just helping people, get on the right track when it comes to building their wealth outside of their 401k. Okay, I'm not a certified financial planner by any means, but I have about 8 years of experience on my own portfolio. I paid out thousands of dollars to pick the brains of some of the greatest investors on planet Earth, and I've actually applied a lot of what they've taught me with my own money outside my 401k because I have more control. And I can tell you have I lost money? Yes, I have lost money. I'm not going to lie about that. I think everybody has. But when I've lost money from my own personal experiences, I've lost much less than what I have on my 401k accounts. And I've actually had way better returns doing something outside my 401k as well. So my 401ks that I've had set up have only returned annually, usually about between 5%, up to maybe about, I want to say like 12%, maybe 13%. So, the most I've ever had as far as return on a 401k for the entire year was like 15%. Okay, and I've had much higher returns than that doing my own trading on my own personal accounts. So if you're going that direction, just remember the risk equals control. Okay, the more control you have, the less risk you have. The less control you have, the higher the risk you have. Okay, so with 401ks, I would say you don't have a whole lot of control, therefore your risk is really high of losing your money. With that being said, these are today's investors' investing tips. You're tuning in to howtoPlayStock.com. If you haven't subscribed to the channel, please do so. And remember, guys, income is the outcome, okay? I'll talk to you later.